Hi, everybody. I'm Alex Polzin, and this is Small Business Taxes. Specifically today, I'm going to be talking to you all about the top 5 things that you need to know as small business owners to be in compliance and to file your taxes timely and accurately. I am the Director of Finance and Administration here at the Iowa Center since August of 2020. Before that, I spent several years in public accounting, focused on small business taxes and accounting issues. So this is right up my alley. I'm really excited to present on this topic with you all today. And on that note, let's go ahead and dive right in.
I'm really excited to be here with you all. We have a pretty big group, so please ask questions, use the chat function. We'd love to tailor this as much as we can. If you do have very specific questions, as we all know, the tax world is kind of crazy. The tax code is a book about this big, and a lot of different factors can impact a given tax situation. So just keep that in mind as we go through this. If you have some really specific questions or you want to reach out to me at the Iowa Center to discuss one-on-one at a later time, just know I will be available to set up meetings one-on-one with you if you'd like to discuss anything that we've gone through today. On that note, I'll go ahead and basically jump right in. One more caveat here. The beginning part of this presentation will be fairly heavy on some technical stuff, some definitions, some links, resources, things like that. And then the second part will be a little bit more of a workshop, pulling up a bookkeeping template, pulling up some tax returns, and really looking at how this all comes together at year end for you when you go to file your business, and then of course your individual tax return. We'll be focused on the business side of things today, but just know you can't normally file your individual taxes until you have your business done for the year. So let's keep that in mind as we go into this. And on that note, we'll dive in. So as we get started here, here at the Iowa Center, we work with small businesses across Iowa, various parts or various points of their small business journey. Some may be established a few years on or more. Others may have just started this year or just starting right now for that matter. So we always want to start with a kind of a tax and compliance focused starting your business page with some links for you. I'm not going to go through all of these, but just know the first step would be to determine your business structure and actually register to do business in the state of Iowa. Depending on your business structure to start, you may have a different requirement to register with Iowa. Most of you may have started out, if you're just the sole owner of your business, as a sole proprietorship. If you do have a sole proprietorship, just know in Polk County, you're required to register that trade name with the county. And then in Iowa, whatever county your business is located in, you'll want to go ahead and contact your county recorder's office and get your trade name registered in the county you're doing business on. I have a link to Polk County. Of course, if you're in a different county, you'll have to get on Google and find their county recorder's office. A lot of people are tending towards LLC formations these days, whether or not they're a single owner or if they're multiple members of their business. LLC formation is really a hot topic, and a lot of people are kind of going for that. That is a little bit more of an intense process. You're required to come up with an articles of organization for your business. You're required to file that through the Iowa Secretary of State website and pay a fee to the Iowa Secretary of State. We have provided some links to some background information on the limited liability company legislation for the state of Iowa, which explains your responsibilities as a small business owner when forming an LLC. And we've got a link to the fast track filing system with the state of Iowa, but just know it's a little bit more involved than that. Here at the Iowa Center, we can't actually prepare your LLC formation documents for you. A lot of clients either try to use the resources we can provide and do it on their own, or they may end up going for LegalZoom. Can be a really nice tool for those that are maybe just single member owners. And then last but not least, some people end up engaging an attorney and paying substantial fee to form their LLC. And again, that could be more important for those of you that maybe have multi-members, 3 or 4 owners in your business. That may be important for you to talk to an attorney before forming an LLC, and especially in making an operating agreement. For those of you that have multiple owners in your business, that operating agreement is a corporate legal document. It's basically the guiding document or the constitution of your business, so to speak. And it really lays out all of the rules for multi-member partnerships or multi-member LLCs. We've got another link here to apply for your social or for your EIN number. I always explain this. If you don't know already, it's kind of the social security number of your business. It will be the identifying number that you will use to file any of your business tax returns, any of your payroll taxes. An EIN number is required to open a business bank account with most banks that I know of. And it can be a fairly straightforward process. It can be done online by most businesses. And this is what the screen looks like. And the link is provided in our slides here that you'll all receive. Last but not least, you need to determine your desired tax treatment. And this is something that I'll talk about here on the next slide. Most of you, when starting your businesses or in the first few years, will default to what's called a flow through or a pass through entity for taxation, meaning that any of that net income, so any of that revenue minus expenses equals net income of your business at the end of the year, eventually works its way all the way to your individual 1040 and is included with all your other sources of income in your tax calculation at the end of the year. That's kind of the default method. So at the beginning, when I said you can't usually file your individual taxes until you get your business done first, that's kind of where I'm going there. It's really important to get the business done first and see that net income flow all the way to your individual return and look at your tax liability altogether with all your sources of income. And we'll go through that here. I have a link here. It's a little bit out of place, but just know the link to Form 2553 is included in this slide. We will get into the pros and cons of a sole proprietorship, a partnership, or an S Corp here in a little bit. But just know if your business is eligible to be elected to be treated as an S Corp for tax purposes, that election is made on Form 2553. It looks like this. It's just a 2-page form. The IRS is super picky that it filled out accurately. So please, contact a tax preparer or contact the IO Center and talk to me about kind of everything that goes into this before you attempt to do this on your own. You want to make sure, one, that your business is eligible to be an S Corp. You want to make sure that, two, it's the right fit for you and the operations that you want to accomplish. And then three, in the actual preparation of the document, you're going to want to make sure you know what you're doing as to get it accepted by the IRS. As we move forward here, I'll talk about this a little bit more, but again, we feel it's extremely important for new businesses to open up a business bank account with the EIN number of their business. This is the first step to being organized in your bookkeeping and summarizing and keeping track of and organizing all of your business transactions, from revenue to expenses to owner contributions that you're putting into the business of personal money to owner distributions that you're taking out as the owner of the business, and then any fixed asset purchases or sales. Those are all things that you're going to want to begin tracking in order to be able to accurately and timely file your tax returns coming up here in a couple months. So on that note, number one, and I know TJ said top 10 things. It'll probably feel like 10 things. I've got 5 major bullet points today to go through. So you guys are getting off a little easy there. It may feel like 10 though, so don't get too excited. As we go through here, the very first point I want to talk about is this concept of flow through entities for taxation. What do I mean by that? In short, what I mean by that is if you are a sole proprietorship, a multi-member LLC, a partnership, or an S Corp, your net income from your business or your ownership share of that net income for 2021 is eventually going to find its way to your individual 1040, and that's where you're going to pay the tax on it. That income gets included with all your other sources of income. Maybe you've got a W-2, maybe you've got a 1099 for some contract labor you did, or maybe you've got some investment income. That's okay. It all gets put together on that individual Form 1040 that we all should be used to filing every single year, and then you pay your tax at that point through your individual 1040. There's one caveat there, and that's for an entity known as a C Corp. I guess just kind of historically, that's your Coca-Colas of the world. Those big entities, those big corporate entities usually have been a C Corp historically. More and more smaller businesses are starting to go towards a C Corp entity because of their tax treatment. It's just a flat 21% rate if you're a C Corp. But there's a lot of other things that we'll get into here shortly about why a C Corp isn't really One, it's not super popular, it's not very common, and it may not be the best idea for small business owners kind of in this group's journey of their small business. Maybe as you get really giant and you're really worried about self-employment taxes and things like that, then maybe a C Corp is something to talk to your CPA about. But until then, we strongly encourage a thorough kind of review of that before journeying away from a flow-through entity. So sole proprietorships, multi-member LLCs, partnerships, and S Corps are flow-through entities. That net income eventually works its way to the individual 1040. If you're a sole proprietorship, you're most likely reporting your business only revenue and expenses and net income on a Schedule C, which is actually an extra page of your 1040 itself. So it's actually prepared within your individual tax return on its own separate schedule. And that we'll see shortly, but that will list your revenue and your expenses out for your business. If you are a multi-member LLC or a partnership, you'll file a separate tax return, information only for your business, called a Form 1065. And this will report again the business's revenue and expenses and give you a net income number. And what happens at that point is a K1, a Form K1 is populated with your ownership share of any of the taxable events that happen in the business. So if you're 100% owner of an S Corp, for example, or sorry, we'll get to an S Corp. If you and your brother, let's say, own an LLC together, you'll file a Form 1065. If you're 50-50, you'll both get a K1 then. Yours will be 50% of taxable income and other deductible items, and your brother's would be 50% of the taxable income and deductible items that are listed on the Form 1065. You, as a multi-member LLC owner, take that K1, you bring it either to TurboTax or to your tax accountant or your CPA and say, hey, I've got this K1 for my ownership share in a business, and they'll tack it onto your 1040. And I'll show you how that works shortly. But again, you focus on those businesses first. Whether you're a sole proprietorship, you're looking at your Schedule C first. Whether you're a multi-member LLC, you're looking at your Form 1065. If you've elected to be taxed as an S Corp, that Form 2553 that I was talking about at the beginning, you're going to want to go ahead and again file an 1120S, and you'll be populated with a K1. As we move forward here, number 2 would be types of small business taxes. So we've kind of talked about that net income flowing from these flow-through entities onto your individual tax return. Your individual tax return is going to take care of a lot of your small business tax requirements and responsibilities, but not all of them. So I want to make sure we go through the types of taxes that you're looking at from a small business. Okay. First and foremost, it's probably the one everybody's thinking about right now. It's your federal and state income tax. That's the stuff coming up due here in April. When you get your net income from your business, you will have that included with all of the other taxable income from your tax return, and it'll go into your tax rate calculation. Now, I have included a couple links here that show you the tax brackets for 2021. It's a question we often get. Well, how much should I withhold for taxes, or how do I know what tax bracket I'm in? Well, it's all based on these IRS tables. And so just real quick, if you're single and your total taxable income is over $40,525, well, you'll be up into that 24% tax bracket, and it can go all the way up to 37%, depending on how much taxable income you make. Now, as we go through here, keep in mind you also have a state of Iowa income tax responsibility as well. So, that's kind of the second big thing to think about when thinking about what type of taxes to keep in mind. And then, the third tax that's based off of your net income, if we skip down a couple bullet points, is your self-employment tax. So that's your Social Security and your Medicare as a small business owner. That is the tax that oftentimes people forget about. And it can cause some unexpected surprises, and it oftentimes can be a big driver of estimated tax requirements and things like in other tax planning considerations. Another type of tax that you may be looking at having to either report, file, and pay right now would be your federal and state payroll taxes. So if you have employees on payroll right now, just know you have some due dates coming up for your federal withholding, Social Security, and Medicare filings on Form 941 with the IRS. And then you have some Iowa withholding requirements coming up, and you have some federal and state, Iowa withholding, then you have some federal and state unemployment insurance reporting and payments coming up as well. Last but not least, some other business taxes that you may be facing this time of year would be your sales tax. A lot of people have sales tax coming up with the Iowa Department of Revenue due on January 31st. Again, if you own your office building, you may have real estate taxes, or you may have other tangible personal property taxes if you have business vehicles and things of that nature. Just a little plug to keep an eye out for that. Before we move on here and get into the meat of this presentation, I do want to just take a second and step back and talk about self-employment taxes, and then a little bit more about sales tax. So again, just to reiterate, if you're a sole proprietorship filing a Schedule C, or if you're a multi-member LLC filing a partnership return, that net income, again, is going to be subject to federal and state income tax based on your marginal income tax brackets, links provided. But that net income is also potentially subject to self-employment taxes. That's the Social Security and Medicare tax. So the way I like to explain this is, me as an employee of the Iowa Center, for example, we're getting paid twice a month. And on that pay stub, I can look at that and I can see my gross wages, and I can see that 6.2% of that was withheld for Social Security, and 1.45% of that was held for Medicare. And then, yes, of course, I have my own federal and state withholdings on there, but that's really not what I'm concerned about here. I'm thinking about the Social Security and Medicare side of things. What I don't see on my pay stub is that the Iowa Center is also paying 6.2% for Social Security and 1.45% for Medicare, in addition to what they're withholding from my paycheck and sending into the IRS. All of that self-employment tax for Social Security and Medicare adds up to 15.3% on eligible wages paid to employees. And so how does that work then for small businesses that don't have any payroll? Maybe you don't have any employees, or maybe you're not paying yourself a salary. Well, the IRS still wants that Social Security and Medicare tax from you, unfortunately. Even if you're a small business owner, you're 100% owner, you don't have any employees, but you're making a profit in your, in your services or your retail sales, they want Social Security and Medicare taxes on that. And that's where you get pegged with that additional 15.3%. So again, if you are a small business owner and you are a sole proprietor, or you are a multi-member LLC who is not elected to be taxed as an S Corp, you're looking at federal income tax, state income tax, and 15.3 self-employment taxes on that net income from your business for 2021. Okay, quick shout out here for S Corps. S Corp's net income is subject to federal and state annual income tax. It is not subject to the self-employment tax additional 15.3%. So a lot of you may have just heard that and scratch your head and go, well, why the heck doesn't everybody just do S Corps then? It's a good way to save 15.3% in taxes. Well, it's not so easy. If you do decide to be an S Corp, just know all of a sudden you're going to have all these federal and state payroll tax requirements coming in, because the IRS wants to see S Corps paying officer salaries to their officers, and they have to be reasonable. So if you are, the best example I have is if you are a 100% S Corp owner and you made $100,000 a year in revenue, let's say you're looking at your thing and other people in a similar industry doing your job that you do for your small business, let's say they make $30,000 a year. Well, per IRS regulations, you should be paying yourself as the officer and owner of the S Corp a reasonable salary of up to $30,000. Now that's where the IRS starts getting their Social Security and Medicare taxes from you as an S Corp owner, because then all of a sudden you are paying yourself a salary. You have quarterly tax filing requirements to withhold federal withholdings, Social Security and Medicare tax, contribute the employer side, and pay those to the IRS throughout the year. So the only difference there really is that the LLC is paying it at the end of the year, whereas the S corp is paying it through salaries throughout the year. As you get bigger and bigger and your profit goes higher and higher and higher, you could start to see, you know, a reasonable salary stay stagnant, and while your net income increases, and that's when you start to see the tax savings for self-employment taxes on an S corp. Real quick shout out for sales tax before I move on here, but for sales tax, just know the Iowa Department of Revenue is your go-to for any sales tax questions you have. They have a website here that I've provided a link for that actually gives you a list of taxable or exempt items here. If you have any questions whatsoever, if your product or service is taxable, look at this list. You can go all the way down here, and it's pretty descriptive until you get to services, and then services themselves. If I keep on scrolling forever, are right here. You know, most services are non-taxable, but Iowa does tax about 75 services, and you can actually pull up the list of taxable and exempt services in the state of Iowa. Now, if you are still unsure after doing your own research, just call the Iowa Department of Revenue, ask to speak to a sales tax specialist, and ask them specifically for your business, and they'll give you an answer. Usually, they're very good about giving some legitimate guidance over the phone with the Iowa Department of Revenue for sales tax specifically. Okay, let's get moving here. We're going to go right up to upcoming tax deadlines. This is here for you, so I won't go through it in detail. Just know if you've got payroll, you've got some deadlines coming up here January 31st for your W-2s. If you've got 1099 requirements, so if you paid a non-employee over $600 for some sort of service, so generally we're talking about contractors or some sort of contract labor, you may have a 1099 filing requirement coming up here end of January. Again, if you do have payroll, you have your Q4 Social Security and Medicare filings coming up through Form 941, and you also have your federal unemployment coming up with Form 940. Same goes for your Iowa payroll filing requirements. You've got Q4 Iowa withholdings, Iowa unemployment, and Iowa sales tax coming up for deadlines. Skipping down here a little bit, if you are required to file a Form 1065 or a Form 1120S, depending on if you're a multi-member LLC, a partnership, or an S Corp, those are coming up due March 15th. So those returns are to be filed March 15th, and K1s furnished to the business owners by that point. A Schedule C and all other components of your individual tax return are due April 18th. Again, normally it's April 15th. COVID's really messed that up the last couple of years, as we all know. This year, at least the plan is now April 18th, which is the Monday following the 15th, which is a holiday in Washington, D.C. So IRS offices will be closed. Last but not least, just know that there is a 6-month extension request available for either your individual tax return, your Form 1065, or your Form 1120S for your annual federal income tax filings. If you do have to file an extension, I strongly encourage you to avoid extensions. Stay up to date. You know, the sooner the better is kind of the best mindset here. But if you do have to file an extension, just know that's only an extension of your time to file. Any taxes owed on that income from your business are still due by April 18th. So what if you don't know how much taxes you have owed by April 18th? Well, I suggest making a really good guess or doing some tax planning to try to get close, because what will happen is interest and penalties will start accumulating on April 19th on any taxes that you end up actually owing, you know, once you get everything figured out and file it with the IRS, and they say, oh, well, it's now 6 months later, it's August 15th, or sorry, it's September 15th, you know, and now I'm getting your tax return showing your business income. Well, guess what? You get 6 months of interest and penalties because you didn't pay it on time. So just keep that in mind as you go forward. Okay, so you know, the second half of the presentation, hopefully I'll get a little bit more into some examples here and kind of show you kind of how to put everything together and flow everything together. I want to pause here quick though and see, TJ, are there any questions that we should address here before I get into some of these examples and kind of more?
Let me double. Nope.
Okay. All right. Well, we'll keep on rolling here. So, okay, number 4, gathering your documents and maximizing your deductions. I'm sure a lot of you are here today to talk about exactly this. Okay. I have a small business. I've been in operation for 2021. Either I've been in business the whole year or I started in 2021, but I know I've got revenue and expenses incurred for my business in 2021. What do I do? Okay, so whether you attempt to prepare your business taxes on your own through a software, third-party software, or whether you engage with a CPA or some other tax preparer to file your business tax return, I've wanted to provide you a checklist here of things that you can think about to get prepared and hand over to file your taxes. Again, my goal here necessarily is not to teach all of you the entire Internal Revenue Code in an hour. That's unrealistic. In fact, it's impossible. But what I want to do is be able to prepare you to not only understand how your taxes are being paid and where that net income is coming from, but I want you to be able to efficiently, have the documents that you need to get that prepared in an efficient manner. And then, as we'll see shortly, I want you to be able to read the tax return, and I want you to be able to understand what the heck shook out at the end of all this madness. So, when we look at this checklist, first and foremost, and the most important, is some sort of 2021 profit and loss statement or other spreadsheet that lists all revenue and expenses from January 1st, 2021 through December 31st, 2021. Pretty self-explanatory. We want to see all sales revenue for all services and products. We want to see all business expenses, and we're trying to come up with a net income number. That net income number is what drives that tax liability. It is what flows from your Schedule C or your K1 all the way to your 1040 that you pay tax on. And so that's really what we're trying to get to. Okay. A 2021 balance sheet, if requested by your tax accountant or your tax prep software, can be very beneficial. And depending on whether or not you have to file a 1065 or an 1120S, it may be required as part of the tax return itself. As part of the supporting documents of those client provided financial statements or trial balances, as it can also be called, most tax preparers would love to see a little bit of supporting documents just to tie some things out. Okay, business bank statement at the year end to confirm that year end bank balance is important. That helps everybody kind of make sure that nothing was missed, whether it was a sale that you didn't capture maybe in your bookkeeping that shows up on the bank statement, or maybe it's a expense, vice versa, that didn't show up. That bank statement and that bank balance is going to help kind of tell that story. Okay, what are we missing? Same with the business loan statements. That can be super important. You do not get a business deduction for loan payments, but you do get a business deduction for interest payments made on business loans. Okay, so it can be really important then at the end of the year to tie out what that actual loan balance is to make sure that you're getting your interest deduction. Okay. And then especially this year, please include any sort of other business loan statements you may have, whether it's a PPP loan document or accompanying forgiveness documentation. Maybe you got an EIDL loan or some other COVID relief related grant or loan. Include all of that information in your kind of packet of tax information when you're going to try to get your business prepared. All of that will have special treatment and will just require a little bit more scrutiny come tax prep time, just to make sure everything's being handled correctly. Again, any business credit card statements at year end, throw those in there. If you can create or manage a schedule of owner contributions and distributions with your bookkeeping, I highly encourage you to include that schedule as well. That will help the tax preparer pull out any tax-free distributions off your P&L. And same for loan payments as well. Oftentimes we see tax clients will make a loan payment and it'll be a line item on their profit and loss. Again, that's not accurate. The loan payment is not a deductible expense. It doesn't belong on your profit and loss. You can't deduct it against your net income. It's going to mess things up. Same with owner contributions and distributions. If you put $1,000 of your own money into your business, that is not a taxable sales revenue item. It does not go on your profit and loss. Same with the tax-free distribution from a small business owner. Most of you, if you make a profit, and I'm not going to just say this is blanket statement because there's different tax rules involved, but most of you, if you have equity in your business, meaning you've contributed a sufficient amount of capital and you have been profitable and you have the funds sitting there in your business bank account at the end of the year, most people either throughout the year or at the end of the year will take out distributions. They'll take some of that profit out of their business. Okay. That does not go as an expense on your P&L unless you did that as an actual salary. Unless you're going to be reporting that money on a W-2 or W-3 or your Form 941 filings for Social Security and Medicare, it does not go on your P&L. It's an owner distribution against your equity. Okay, so it's really, really important to kind of distinguish some of those different items, and I'll go through that a little bit more here when we look at some of our kind of quote unquote real world examples. Last but not least, any fixed asset addition, sales, or disposals is super helpful. Most small business owners elect to do the IRS de minimis safe harbor of $2,500. What I mean by that is if you have any fixed asset purchases, so I'm talking about equipment, machinery, vehicles, maybe a really expensive computer or TV, something like that for your business office or for your business operations. If it's greater than $2,500 in value, normally people will capitalize that and move that over to the balance sheet as a fixed asset. And depreciate that over a matter of years, as opposed to taking the entire expense on their profit and loss in the year they purchased it. Okay, the IRS allows a lot of different depreciation treatment for items, tangible personal property that's greater than $2,500 to spread those deductions out over a matter of years. So make sure you're indicating that in whatever bookkeeping format that you do. I want to go through this here quickly, and then I'm gonna pull up in a couple different examples. I just want to quickly, okay. So a couple things, maximizing your allowable business deductions before we actually see some of this in practice. Again, mileage. Don't forget about mileage. I think most of us are aware the 2021 mileage rate is 56 cents per business mile driven. Now, a couple caveats here. A lot of you have a business, maybe it's a service-based business or retail sales, or maybe it's a restaurant. There's a couple things here when calculating mileage. You can't include mileage from your home to your office. So what I mean by that, let's say you own a restaurant and you want to track your mileage. It's not deductible mileage to drive from home to work and from work to home every day. If you drive from home 3 hours up to northern Iowa for a business meeting and then back home or back to the restaurant, okay, we're talking business. We're talking business mileage. If you are a service-based company that has a home office, let's say, of course you won't have any mileage day to day unless you go out and you go to a client meeting, or you travel to see the client, or you travel to pick up office supplies, or you travel to do some other type of business, ship something. That is deductible mileage. So it's business miles driven in the normal course of business, other than from home to office and office to home. Now, I strongly encourage people to track their business mileage either through an app or in a notebook right next to their, right next in their car somewhere. The IRS, in fact, requires you to contemporaneously track mileage, meaning they want to see you doing it in the moment. That's not always realistic, and a lot of times people can retroactively go back and reasonably build that mileage log, but just try to be as accurate and as in the moment as you can with that. On the flip side, those of you that do have heavy business use vehicles, just know that there's some depreciation things that you can do there, but you cannot take your actual depreciation, gasoline, repairs and maintenance, oil, all that stuff, and mileage. You have to take either mileage or actual. Okay, so just kind of log that away. If you're doing mileage, forget about the rest of that, gas, other stuff. You won't be able to deduct it anyways. As we go through here, I've listed some common deductible expenses for you to review on your own, but just quickly: office supplies, computer equipment, software, tools and machinery, wages, payroll taxes, contract labor, yada, yada, yada. You can see it all right there. Last thing I want to talk about here before I pop into some other things, just so you're aware of it when I'm going through the actual tax return, is the qualified business income deduction. This is a new deduction that came through the Tax Cut and Jobs Act. For eligible small businesses, it will be a 20%, it'll be a deduction equal to 20% of the net income from your small business. So it can be very lucrative deduction on top of everything else that we're talking about here, and I want you to be aware of it. Okay, on that note, let's go ahead and pop up some examples here. So
Here's a quick
number 5.
question.
Oh yeah, go ahead.
It's this is 5 blocks handyman service. It says based on your statements, what if they put time fixing their business office? Wouldn't it be considered as self-investments time and could be converted in expenses?
So the time that you put into something is not able to be converted into a deductible expense. Okay, so you would have to actually pay yourself a salary to be able to deduct that against your business. You can deduct the materials that you spent to make the improvement to your office, and any repairs and maintenance, any tools. If you paid a contract laborer to come in and install something or make some of those repairs, that's deductible. But there is no calculation to be done for owners' time invested into the business. It's specifically cash in, cash out. It's money. That's what the IRS is looking for when they're determining your deductions. Okay, I hope that answers that question. As we go through here, I want to show you kind of how I try to put this all together. So right here is the bookkeeping template that we use for a lot of the clients here at the Iowa Center. Again, I realize some of you may be using QuickBooks and it's a matter of going to your reports and clicking the profit and loss statement out for the year, and it'll give you something that looks like this. You're golden. That's great. If you're up and running on that and efficient in that process, you know, this part isn't necessarily for you, but I want to show, the vast majority of people on this call may be using some sort of Excel-based bookkeeping method. And I just want everybody to feel comfortable with that and show how it all kind of ties together. So this morning, actually, I went through and I put together kind of a fake or an example of my business profit and loss statement for the year ended December 31st, 2021. And, we consider this a t-shirt shop or maybe an embroidery business. It is kind of what we're looking at here. And, we went through and for each month, I went ahead and dropped in the revenue, the returns, the cost of goods sold, all the way down to advertising, depreciation, and business insurance, office supplies, rent. These are all of the different types of common business expenses that we want to be tracking throughout the year. Now, the way I got here was by looking at the business bank statement. So the way you start building this is you literally go to your business bank statement or your notebook or wherever you're recording those business transactions, and you look at the month of January 2021 and you start filling in this template. And you look and say, okay, well, I had 5 days of sales for, that totaled $2,000 in January. So there's my summary sales line item, $2,000 in January. You do that again for cost of goods sold. Okay, so I had $250 in materials expenses in January 2021 that went towards selling the t-shirts. And then you just keep going through. You look at that business bank account and you add up all of the like type of transactions. We're really trying to get all of these transactions for the month, or as we'll see for the year, into specific categories that we can then report on the tax return and come up with a net income. So I went through that process then, theoretically, January through December for every single month. And I'm looking at my bank statements and I'm looking at my credit card statements for my business. And I am capturing every single dollar of sales revenue that I received and every single business expense that I incurred throughout the year, to the point where I then end up with a full year column right here to look at. Okay. And this is really what you need to get to in order to begin the tax preparation process. You need to come up with an accurate set of bookkeeping that shows your 2021 net income. So that's what this column shows. It shows the full year's revenue of 25,000. It shows some returns. It shows some cost of goods sold. It shows about $10,000 of operating expenses for a net income down here of $10,000. So the first thing that I want to point out here to the group is that you are not paying taxes on the $25,000 of sales revenue that you brought in. You're also not paying taxes on the $4,000 of owner distributions that you took out of this $10,000 profit. You are paying taxes on the $10,000 net income that you calculated and supported through your bookkeeping, which is then supported by your bank statements and your receipts and everything else that you used to build this. Say that one more time. You are paying taxes on the net income, this $10,000 number. You are not paying it on your revenue, and you're potentially not paying it on any owner distributions that you took out of the business. Okay, so if I use this example and I say, okay, at the end of the year, I came up with a nice round $10,000 of net income, odds are it's probably not going to be that nice and clean. But for sake of example, it works well. You first and foremost, the process here then, for me, if I think about this as a sole proprietorship and I'm a Schedule C, well, I'm going to go ahead and start popping that in to a form Schedule C. And here it is. Okay. Right away, when we look at this form Schedule C, we can notice a few things. And I know tax returns are scary. And, it took me years to even want to start reading it. It's like my eyes naturally closed when I see all this junk. But it's not as complicated as it seems. This first section is just informational only. It's my business, shirt sales, yada, yada, yada. If you look at the rest of it, it looks pretty darn similar to what I just worked on the whole year. It looks, in fact, identical to what I just worked on the whole year. And so if I am preparing a Form 10 or a Schedule C on my own, or if I am checking my tax accountant who prepared a Schedule C, it should look just like my bookkeeping, because I know my bookkeeping is supported by bank statements and receipts that prove that those business transactions occurred. So now I feel comfortable reporting that and paying taxes on that because I know that's my true net income. So pretty darn easy at this point. 25,000 up there. Returns and allowances, I'm just pulling this off, was 1,200. Cost of goods sold was 3,000. If you were using some sort of tax software, or your tax accountant would go ahead and just do it for you. Gross profit of 20,800. 1,800. Just to kind of reiterate what I'm talking about. Here it is for the full year. There's your revenue, your returns. There's your cost of goods sold, 20,800 of gross profit. And then you do the same exact thing. I'm not going to do it for all of them, but you keep going down through your whole list of transactions that you've summarized. Expense, advertising, depreciation, insurance, all that. If you want to look at common expenses that you should be thinking about and tracking, look at your Schedule C. They're all listed right here. Advertising, auto, contract labor, depreciation, insurance. It's all there. Rent, supplies. So you just start going through here and you pull it right off your bookkeeping until you get to the same answer of $10,000. $10,000 in net income. There's the $10,000 in net income on my Schedule C. And that is what it's all about. We are coming down to line 31, net profit on your sole proprietorship. That is what's going to drive the tax. Okay, this $10,000 on a Schedule C for sole proprietorship, again, it's flow through taxation. This taxable income finds its way to your 1040. It does that by going to what's called a Schedule 1. Schedule 1 is an additional schedule to your Form 1040, and it lists all these other areas that you may have accrued some income other than just simply, making a salary or investment income. If you have a Schedule C and you've calculated a net profit of $10,000, well, there it goes. You dump it right in there to line 3, business income, Schedule C, 10,000. Okay. We're not done yet though, because I know as a small business owner, I also have an S corp. That's the trick. That's the tricky one here. I own an S corp where I do consulting for specifically for other t-shirt businesses. They pay me to go into their t-shirt shop and give them my advice to be a successful business. Now, for various reasons that are just made up for this example, I've decided that I want that entity to be elected taxed as an S corp. We know that when you elect to be taxed as an S corp, you have to file a Form 1120-S. So we are no longer looking at a Schedule C for this second business entity for my consulting. We are looking now at a Form 1120-S for an S corp. Now this Form 1120-S for an S corp, again, is fairly straightforward. We have the identifying information up top. We have the sales and revenue information and cost of goods sold information here. And we have the various deduction information here to get to an ordinary business income amount. For sake of example, I've made it $10,000 again, but notice I've got this number up here. Okay, I said I've got $60,000 of other expenses that I incurred to make $100,000 of revenue. But as an S corp owner, I've done my research and I know that a reasonable salary for the work that I did for this business is $30,000 a year. So per the IRS regulations governing an S corp, I have to pay myself salary and I have to issue myself a W-2 for $30,000. And you see that as a deduction on the business right there. All the way down to this $10,000 ordinary business income. Now, just know there's other reasons that an S corp is more complicated. They make you fill out all these other forms that I didn't go through the trouble to fill out, but it specifically breaks out all the different activity that you may have. And it also generally requires you to have a balance sheet here. Okay, but we're not going to worry about that right now. Really what we want to know is, okay, $10,000. Now, to make things simple, this S corp is 100% owned by me. Okay, I told you guys at the beginning that if you have an S corp or if you have a partnership, Form 1065, you're going to get a K1 to file with your individual 1040. Now, that K1 looks just like this. In this case, 2021 Schedule K1 for an 1120-S ABC S corp. Alex Polzin is the owner, and I'm 100% owner. So pretty easy K1 for me right there. Ordinary business income, 10,000. I get it all. 100% owner, I have to report all the ordinary business income as tax. Okay, so I'm not quite done. As we know, S corps, partnerships, multi-member LLCs, sole proprietorships, they all eventually flow to my individual 1040 if I'm going to accurately and timely file my tax returns and pay the appropriate amount of tax. So where does this $10,000 number go from your K1? Well, let's get right back to additional income Schedule 1. And if we keep on going down, we see another line: rental, real estate, royalties, partnerships, S corps, Schedule E's. But there's your partnerships and S corps. So that's your kind of trigger. Okay, my K1 income goes there. And there you see your $10,000. All sorts of other types of income that we're not going to go through here, but just know that for this example, we've calculated $20,000 of small business other income that we're going to report on our individual 1040 due April 18th. So let's see how that all comes together on that Form 1040. 2021 1040, this should be fairly familiar. Alex Polzin, just some identifying information. This is what I want to focus on right here. This is the part of the tax return I want you all to be able to read. Whether or not you prepared it yourself or you used TurboTax or you paid a CPA to do it, I want all of you to be able to, on the face of your tax return, page 1 and page 2, pull out the important information so that you can do a mental check. Does this make sense? I'll admit, not happily, but I'll admit CPAs are not perfect. We make mistakes, and it's on you as the small business owner to ensure that your taxes that you're signing and that you're paying are accurate and that you're comfortable with them. Okay. And so on that note, let's look and see then out of this example, All right. First things first, I know, okay, well, crap, I paid myself $30,000 in wages. I've got a W-2 from ABC S Corp that I'm 100% owner in, and I've got to report that as wages. So we see that right there on line one, $30,000 of taxable income right there. Okay. Yes, it was a deduction on the business. So it kind of nets itself out there. But again, it's part of the IRS's way to make you pay your Social Security and Medicare taxes on that 30,000. As we go down, a little bit of interest income, got a savings account. Got a savings account as we go. And then as we go down, here's the main line for most of you small business owners out there that you're going to want to look at when your tax return gets handed to you, 2021, here you go, here's your tax due. Take a look at line 8. That should total the net income from all of your small business entities, whether it's a Schedule C, whether it's a K1 from an S Corp or a K1 from a partnership, or if you're a farm and you have a Schedule F, or a rental property and you have a Schedule E. That net income is all going to get summarized into line 8 right here, 20,000 bucks. Okay. And then it gets included with everything else you've got. So if you've got IRA distributions, or you took money out of your 401k, or you've got Social Security benefits coming in, it'll all be listed here and included in what's called your adjusted gross income. Your adjusted gross income is what you look at, when you're trying to figure out your marginal tax. Well, I'll stop there. But your adjusted gross income is something to just keep your eye on. You see that pop up in a lot of different applications that you may fill out as a small business owner, things of that nature. Now, standard deduction, we all get it as an individual in the United States of America for filing our tax returns. Don't worry about that. Here is line 13. This is that thing I blew right through earlier on in the presentation, your qualified business income deduction. It's a fairly complicated deduction. It's fairly new. It's from the Tax Cut and Jobs Act. There's all sorts of different factors that impact what that actual deduction is going to come out to be. But what I want you all to know as small business owners is that if you have a profit on your small business, so if you have a Schedule C or you have a K1 and that's showing a net profit or an ordinary income amount that you have to report on line 8, odds are if you've got an amount on line 8, you should see a corresponding deduction on line 13. The maximum deduction is 20% of that income. So I went ahead and put the max in here, but that would be a $4,000 deduction on $20,000 of income. Pretty substantial when we're talking about maximizing our deductions and limiting our overall tax liability. So I just want everybody to make sure that when you get your tax return back for 2021, you're looking at line 8, other income. Does that make sense to me? Okay. Does my total income, line 11, make sense to me? Okay. And do I have a qualified business income deduction on line 13? If not, just ask why. If it's TurboTax, call the help. If it's your CPA, ask them what happened. They may have just missed it. It's a fairly easy thing to miss, actually, unless you're, clicking all the boxes and checking all the things in the tax software. That all then gets us down to taxable income of $33,465 because we've got our $12,555 standard deduction. We've got our $4,000 qualified business income deduction to get us down to $33,465. Again, that includes the Schedule C net profit. It includes the business income from my K1. It includes my salary I paid myself. And it gets me to $33,465. That is the number that then calculates your federal and state income tax. Again, just to remind everybody, here's the bracket. I used this bracket to calculate this tax by hand and figured out that, losing my spot, figured out that the tax for federal income was $3,817. It puts me in the 12% tax bracket. That's what it is. But I'm not done yet. One last piece of the puzzle, self-employment taxes, that 15.3% Medicare and Social Security I talked about. That part of it is separately broken out on page 2 of your tax return on line 23. That again, that is not federal and state income tax. That is your Social Security and your Medicare. Just to kind of reiterate here, the $10,000 from sole proprietorship is subject to 15.3% Social Security and Medicare tax. The $10,000 from the S Corp K1 is not. It is not subject to it because I'm already paying the Social Security and Medicare on $30,000 of wages. So 15.3% of $10,000 subject to self-employment tax is $1,530. Just quick, kind of not exactly accurate, but by hand tax is $5,347. I know I didn't pay any taxes in throughout the year. So I owe $5,347 at the end of the year. Last couple things to know, your total tax line, number 24, this is what drives your tax planning and your estimated tax payments for the next year. Down here on line 37, that's the amount you owe. If you did pay some estimated taxes real quick, so let's just say you paid $1,500 of estimated taxes, meaning you paid $6,000 of taxes throughout the year. Because of tax planning, you kind of assumed I was going to make this much in income based on last year or the year before. I know that $6,000 was paid in, 5,347 was my total tax. So guess what? I actually don't owe 5,347. I actually get an overpayment of 653, which I can then either get refunded to myself or then apply to next year's estimated taxes. We just got a couple minutes left here, so I'm going to get out of this section very quickly. And I just want to quickly touch on estimated taxes here. Just know I've got some information for that. If you are looking at paying estimated taxes for 2022 or for 2021 for that matter, just know there's a safe harbor there. So if you have paid throughout the year 90% of your total tax calculated on your 2021 return, or 100% of the total tax on your 2020 return, you won't get estimated tax penalties. Otherwise, the IRS wants to see, for small business owners, estimated taxes paid throughout the year. As we know here on our example, we had $20,000 of total business income that came through either a sole proprietorship or an S corp. That money did not have any withholdings on it. As I get paid a salary twice a month, I'm withholding my federal income tax, and my employer is paying that to the IRS throughout the year, so that when I go back and file my taxes at the end of the year, I've got a significant amount of payments made. Obviously, for small business owners with $20,000 of net income to report for taxes, there's been no withholdings made on that. And that's where estimated tax come in. That's where this big 2022 tax planning considerations page comes in, because that's when you want to look and say, okay, well, if I owed $5,000 or $6,000 in 2021, that tells me for 2022, I should be making quarterly tax payments of $1,500. So that 2022 tax time comes around, I'll break even, and I'll have already paid in the taxes I owe for a year. I won't have any additional tax liability, and I won't have any estimated tax payment penalties. And that's really the way that all works out for you. You know, I know we're coming to the end here. I want to just throw it back to TJ. Tons of information that we went through. I hope it was beneficial. Again, if you want to go through anything else in detail with me or one-on-one for your specific business, please reach out and we'll get a coaching call set up with you.
Even though we're hitting 1 o'clock, I figured we could still answer a couple of questions. One is, when we make our estimated SE taxes with the IRS, do we differentiate between estimated income and FICA, or is it all applied together towards total tax owed?
It's all applied together for total tax. That's a great question. So those two line items I showed you on page 2 of your 1040, you'll have a total, you'll have a tax calculated. That's your federal income tax. And then you'll have the self-employment taxes and other taxes below. That totals to total tax. And that total tax number is the one that you want to look at.
And then the next question was, so QBI deduction applies to each partner's share of the income?
Correct. So it flows all the way. It's based off of that net income number from either your Schedule C or your K1. And it flows all the way then to your other income on page 1 of your 1040. And that's going to be the number that will drive your share of the qualified business income deduction. So it's calculated on the shareholder or owner's shares level. That's correct.
Okay, so thank you again so much, Alex, for spending your time with us today. Thank you to the audience for checking in with us. We will share this presentation to your emails. We will share Alex's information. If anyone needs referrals to any tax accountants, we could get referrals out to you as well. I wanted to take a quick moment to share information about one of our upcoming Small Business Essential webinars. It'll be January 25th, and it's Protect Your Small Business from Fraud. Please check out our website for more information on that webinar, classes, and other information. Also, if assisting people in the small business community is something that interests you, we are hiring now at the Iowa Center. Please look at our job listings on our website, or always feel free to contact me with any questions you may have. With that, I'll close with that one piece of information I always like to end our sessions out, which is love what you do and do what you love. Have a great afternoon, everyone. Bye.